The math fits on a napkin. The house rents for $2,000 a month. The mortgage payment is $1,400. $600 a month, arriving whether you work or not. While a tenant slowly buys the house on your behalf. Do it 5 times and you've replaced a salary. Do it 15 times and you never work again. That calculation is the single most influential piece of arithmetic in personal finance. It has launched more books, seminars, and late-night decisions than almost anything else in the category. And the strangest thing about it is that every individual number in it can be completely accurate while the conclusion is completely wrong. Because that $600 is not profit. It isn't income, it isn't yield, and it isn't yours. It is an unfunded reserve account for a list of expenses that have not happened yet, and the entire outcome of owning a rental property depends on whether the owner understands that before the list arrives or after. What follows is that list, the 4 different things a landlord is actually buying, and the specific sequence of events that turns a property generating $600 a month into a forced sale. That sequence has a name in the industry, sort of. Mostly it just gets called what happened. Start with the reframe, because it's the thing that makes everything else legible. When someone buys a rental property, they think they're buying one asset that produces one thing, rent. They're actually buying 4 returns bundled together, and the 4 behave nothing like each other. The first is cash flow, the money left after every real expense. The second is amortization, which is the portion of each mortgage payment that reduces the loan balance rather than paying interest. The third is appreciation, the change in the property's market value. The fourth is tax treatment, the way the tax code allows rental income to be reported. Here's the part that reorders the whole picture. Those 4 returns have wildly different sizes and wildly different accessibility. Cash flow is usually the smallest and it's the only one you can spend. Amortization is real money, but you cannot touch it until you sell or refinance. Appreciation is often the largest by a wide margin and it's entirely outside your control. And tax treatment is not a gift, it's a deferral, which we'll get to. Because it comes back. So the landlord's actual situation is this: the return they can use is tiny. The return that makes them wealthy is illiquid and unearned. And the gap between those two facts is where every disaster lives. But before any of that, there's an entry cost that the napkin never includes. Financing an investment property is meaningfully harder than financing a home you live in. Lenders typically require 20 to 25% down rather than the low single digits available on owner-occupied loans. And they usually price the interest rate higher, commonly a fraction of a percentage point to nearly a full point above comparable owner-occupied pricing, because a borrower under financial pressure will protect the roof over their own head before the roof over a tenant's. That's not cynicism. It's observed default behavior, priced into the loan. Then add closing costs, which routinely run 2 to 5% of the purchase price. Add the reserves most lenders want to see sitting in an account. Add the make-ready, the paint, the flooring, the appliance the inspector flagged, which on an older property can quietly reach 5 figures before a single tenant applies. On a $300,000 house, that's roughly $75,000 down. Perhaps $8,000 to $10,000 in closing, and call it another 8 in make-ready. $90,000, more or less. Deployed to acquire a position that generates, according to the napkin, $7,200 a year. Which is an 8% return on cash. Very respectable. Also, as we're about to see, fictional. And notice something about the structure. The lender put up $225,000. The owner put up $90,000. The lender's money is the majority of the purchase. Which means the lender's underwriting standards, not the buyer's optimism, determine whether the deal happens at all. And at what cost. The tenant may be the one paying, but the lender is the real partner in the enterprise. And it's the only partner with the power to end it. So let's examine what the tenant's money is actually doing when it lands. Take that $1,400 mortgage payment. the pitch is that the tenant is buying the house for you. In the long run, that's genuinely true. In the short run, it's barely happening at all, and the reason is how amortization works. On a $225,000 loan at 7% over 30 years, the first month's interest is roughly $1,300. The portion that reduces the balance, the part that's actually building your equity, is a little over $100. Not $100 in something per month for a year. That's the first payment, and it's the worst one. The proportion improves every month, but slowly enough that on a standard 30-year loan you're typically past year 18 before principal and interest are splitting the payment evenly. So in year 1, the tenant is not buying you a house. The tenant is buying the bank an income stream, and buying you a $100 a month savings plan. The someone else pays off your mortgage story is true, but it's a statement about the 2040s. That's return number 2, sized honestly. Now let's do the same to return number 1, which is where the napkin actually breaks. Rent is $2,000. The expenses that the napkin omitted, in the order they tend to surprise people. Vacancy. No property is occupied 100% of the time. A reasonable planning assumption in a stable market is 5 to 8% of gross rent, which is roughly 1 month every 12 to 20. Call it $120 a month. Turnover. When a tenant leaves, you pay for cleaning, paint, likely some flooring, listing costs, and the days the unit sits empty. On a mid-market house this can easily run $1,500 to $3,000. And if tenants stay an average of 2 years, that's $50 to $125 a month amortized. Property management. Typically 8 to 10% of collected rent, plus commonly a fee of half to a full month's rent for placing a new tenant. $200 a month. And if the owner self-manages to avoid this, they haven't eliminated the cost, they've converted it into unpaid labor, which is a real cost that simply doesn't appear on a spreadsheet. Maintenance. The routine, ongoing stuff. Leaks, garbage disposals, a fence panel, the call at 9 on a Sunday night. Rules of thumb vary from 1% of property value annually to a fixed dollar figure per unit. Per month, on a $300,000 house. A couple hundred a month is not aggressive. And then the category that does the actual killing, capital expenditures. These are the big, replaceable systems. And they're distinct from maintenance because they don't cost anything for years and then cost everything at once. A roof might last 20 to 25 years and cost $10,000 to $15,000 to replace. An HVAC system, 15 to 20 years, several $1,000s. Water heater, 10 to 12 years. Add exterior paint, windows, appliances, flooring, driveway. Do the arithmetic on just those. A $12,000 roof over 22 years is about $45 a month. Add the HVAC, the water heater, the appliances, the flooring. And a properly funded capital reserve on a single-family house commonly lands somewhere between $150 and $300 a month. Now stack the whole list against that $600. Vacancy, turnover, management, maintenance. And capital reserves alone can consume $700 to $900 a month, and we haven't touched property taxes or insurance, which on most loans are collected inside the mortgage payment through an escrow account. So they were technically in the $1,400. Fine. Even granting that, the $600 is gone. In many markets it's not merely gone, it's negative. This is why experienced operators use what's known as the 50% rule, the crude heuristic that, over a long enough period, roughly half of gross rent will be consumed by operating expenses, excluding the mortgage. It's a blunt instrument and it's wrong in any given month. Across a decade, it's uncomfortably close. Which sets up the most important idea in this entire subject. None of those expenses arrive on schedule in year 1. A recently renovated house with a good tenant will genuinely produce something close to $600 a month. For a while. The roof doesn't fail in month 3. The tenant doesn't leave in month 5. The HVAC doesn't die the first summer. So the new landlord's first 2 years feel exactly like the napkin predicted, and they conclude the napkin was right. That's not a small psychological detail. It's the mechanism that scales the risk. Because a landlord who believes they're clearing $600 a month per house does the obvious thing, they buy more houses. Often by borrowing against the first one. The early absence of expenses gets mistaken for the permanent absence of expenses. And the position gets larger right before the bills mature. The largest expense in a rental property isn't the mortgage. It's the accumulated obligation you can't see, because it hasn't happened yet. And thin margins have a second property that makes everything worse: they amplify small revenue changes into large ones. Suppose the property is actually clearing $100 a month after honest reserves. That's $1,200 a year. 1 month of vacancy costs you $2,000 in lost rent. That single vacant month didn't reduce your annual profit by 8%. It erased it and put you $900 behind. Because the loss came out of the thin layer at the top where every dollar was net. That asymmetry is why landlords will do things that look economically irrational, accept below-market rent from a good long-term tenant. Skip a rent increase, absorb a repair without complaint. It isn't sentiment. A tenant who stays 4 years and never triggers a turnover is worth more than a tenant paying $100 more who leaves every 12 months. Occupancy stability, not rent maximization, is where small-scale landlording is actually won. Which raises a question about what a landlord is really selling. The intuitive answer is shelter. The more accurate answer is credit. Every month, a landlord delivers a full month of housing and collects payment for it. The tenant occupies the property before the risk is resolved. That is, functionally, an extension of unsecured credit, roughly 1 month's rent, to a stranger, renewed monthly. With no collateral and a recovery process that runs through the courts. And that recovery process is slow and expensive by design. Eviction timelines vary enormously by jurisdiction, a matter of weeks in some places, many months in others. Longer where courts are backlogged and the landlord pays legal costs, carries the mortgage. And forgoes rent the entire time, with a low probability of ever collecting the judgment. Add the damage and turnover that often follow. So the single highest leverage decision in the entire business isn't the purchase price, the interest rate, or the renovation. It's tenant selection, a credit underwriting decision, made by an amateur, usually in an afternoon. That determines whether the asset produces income or litigation. Professional operators treat screening as the core competency of the business. Beginners treat it as paperwork. Now to the return that quietly dominates all the others. And the mechanic almost nobody outside the industry knows. How does a rental property's value get set? For a single-family house, its comparable sales and appraiser looks at what similar nearby homes sold for. That means the value of a rental house is driven mostly by what owner-occupant buyers will pay. Which depends on wages, local demand, and above all mortgage rates. The rent has almost nothing to do with it. But cross a threshold, generally 5 or more units in the United States, and the valuation method changes completely. Commercial residential property is valued by capitalization rate, annual net operating income divided by a rate that the market determines based on prevailing interest rates, perceived risk, and investor appetite. Sit with the implication, because it's the most important consequence in commercial real estate. If a building produces $100,000 of net operating income and the market cap rate is 5%, the building is worth $2 million. If the cap rate moves to 6.5% because interest rates rose and investors now demand more yield, that same building, with identical income, identical tenants, and identical everything, is worth about $1.5 million. $500,000 of value evaporated. Nothing happened to the property. The change occurred entirely in the price of money. This is the structural fact that makes real estate a leveraged interest rate bet wearing the costume of an income business. And it's the reason the collapse we're about to walk through happened to sophisticated professionals rather than novices. Before that, the fourth return, because it's the one people most badly misunderstand. The U.S. tax code allows an owner of residential rental property to deduct depreciation over 27.5 years. On the theory that the building wears out. Land isn't depreciable, but the structure is. On a house where the building is worth $240,000. That's roughly $8,700 a year of deduction against income the owner never actually spent. It's a phantom expense, and it can make a profitable property show a loss on paper. Two catches, and both are load-bearing. First, whether those paper losses can offset your other income is restricted. Rental losses are generally passive. And while there's a special allowance of up to $25,000 for active participants, it phases out between $100,000 and $150,000 of adjusted gross income and disappears above that. Unless you qualify for real estate professional status, which requires more than 750 hours in real property trades in more than half your working time. A genuinely high bar for anyone with a day job. Those losses often just sit there, suspended, until you sell. Second, and more consequential, when you sell, the depreciation you claimed gets recaptured. The unrecaptured Section 1250 gain is taxed at a federal rate of up to 25%. So every year you deducted that $8,700, you weren't receiving a gift. You were borrowing from the tax authority, interest-free, with the balance due at sale. There's an escape hatch, the 1031 exchange, which lets you roll proceeds into another qualifying property and defer the whole bill, provided you identify a replacement within 45 days and close within 180. It's real, it's widely used, and it explains a great deal of investor behavior. But note what it does: it defers. It doesn't forgive. Which means many long-term investors are running a strategy whose central requirement is never selling. We now have every component. Let's run the chain. Start with a property clearing a genuine but thin margin. Insurance and property taxes are paid through escrow, meaning the lender collects a monthly amount and pays the bills annually, then recalculates. Now the insurer raises the premium. This is not hypothetical. U.S. homeowners' insurance costs rose sharply across the early 2020s, with the steepest increases in states exposed to hurricane, wildfire, and severe convective storm risk. In Florida and Louisiana, the disruption went beyond price. Major carriers reduced or withdrew coverage. And Florida's state-backed insurer of last resort swelled with policies the private market wouldn't write. Meanwhile, in fast-appreciating markets, county assessors reassessed properties upward, raising the tax bill. Both of those flow through escrow. The lender recalculates and the monthly payment jumps, sometimes by $200 or $300, sometimes more, with no negotiation available. The thin margin was $100. It's now negative $200. The owner is paying to hold the asset. So they do the only thing available without new capital: they defer. The roof gets one more year. The HVAC gets serviced rather than replaced. This feels like prudent triage, and it works, briefly. But remember what capital expenditures are: obligations that accrue silently and then present all at once. Deferring them doesn't reduce them. It converts a scheduled expense into an unscheduled emergency, and unscheduled emergencies in buildings tend to involve water, which damages everything it touches. The failure arrives. Now it's not a $12,000 roof, it's a roof plus ceilings plus flooring plus remediation. The tenant, the good, stable, long-term tenant whose retention was the whole basis of the property's economics, has spent weeks in a damaged house and gives notice. Vacancy. Turnover cost. 2 months empty during repairs. That's $4,000 in lost rent and several thousand in work, on a property that was already negative. The owner decides to sell. And this is where the earlier mechanic returns with real force. The reason the payment rose, the broader rate and cost environment, is the same reason buyers are now paying less. If it's a house, higher mortgage rates have shrunk what owner-occupants can afford. If it's a small apartment building, cap rates have expanded, and the value fell mechanically, regardless of how well the property was run. Then transaction costs. Selling real estate has historically cost 6 to 10% all-in agent commissions, transfer taxes, title, concessions. The 2024 National Association of Realtors settlement changed how commissions are negotiated and disclosed in the U.S. and has put some downward pressure on those figures. But selling remains one of the most expensive transactions an ordinary person ever executes. $90,000 went in. 18 months of amortization built maybe $2,000 of equity. Value is flat to down. 8% of the sale price disappears at closing. Suspended losses release, recapture triggers on whatever depreciation was claimed. The property never sat empty for long. The tenant paid on time. Nothing dramatic happened. The owner still lost most of their capital. Because a leveraged asset with a 2% net margin cannot absorb a $300 monthly cost increase. And everything after that was consequence. If that seems like an unlucky edge case, consider that the exact same sequence took down professional operators holding thousands of units, and it's one of the best documented financial episodes of the decade. Between roughly 2020 and 2022. A wave of apartment syndicators, firms pooling investor money to buy large complexes. Largely in Sunbelt markets like Texas, Arizona, Georgia, and Florida, bought aggressively into a market where rents were rising fast and money was nearly free. Many financed with floating rate bridge debt, short-term loans whose interest rate adjusts with benchmark rates. Chosen because they were cheap and flexible and allow to buy, renovate, raise rents. Refinance in 3 years plan. Then the Federal Reserve raised its policy rate from near zero starting in March 2022 through 2023. One of the fastest tightening cycles in decades. Floating rate debt did what floating rate debt does, the payments rose, in some cases roughly doubling. Simultaneously, insurance premiums in those exact markets spiked, property taxes were reassessed upward on the inflated purchase prices. And the rent growth the entire plan depended on flattened as new supply delivered. Every income assumption weakened while every cost line rose. The clearest early marker came in April 2022. When Apple's Way Investment Group lost 4 Houston apartment complexes, roughly 3,200 units, to foreclosure. In what was reported at the time as one of the largest multifamily foreclosures of its kind in the region. Tied to floating rate loans. It was widely covered as an anomaly. It was a leading indicator. Over the following 2 years, distress spread across the Sunbelt syndication world, with loan modifications. Capital calls asking investors for more money to keep deals alive, equity wiped out, and further foreclosures. And note what did not cause it. Occupancy in many of these properties held up reasonably well. Buildings were full. Rent was being collected. The assets were destroyed by the interest rate on the debt, the price of insurance, and cap rate expansion, 3 forces that have nothing to do with tenants, management skill, or the quality of the buildings. This is the proof of the central claim. Real estate presents itself as an operating business. Under stress, it behaves like a leveraged bond position. And the thing that kills it is usually the financing, not the property. So how has the industry adapted? In 2 directions, and the split is instructive. Institutions went the opposite way in the previous cycle and got rewarded for it. Starting around 2012, in the wreckage of the foreclosure crisis, private equity firms began buying single-family homes at scale, Blackstone's Invitation Homes being the most prominent, assembling tens of thousands of houses and eventually taking the entity public in 2017. That worked because they bought when prices were low, with access to institutional capital, and could spread fixed overhead across enormous portfolios. Their edge is scale, 1 maintenance operation, 1 leasing platform, national insurance negotiating power. and geographic diversification so no single storm or local recession is fatal. That model has since expanded into build-to-rent, where entire subdivisions are constructed as rentals from the outset. The small landlord cannot compete on any of that. But there's one weapon the individual holds that the institution largely doesn't. And it's the reason the individual isn't obsolete. The long-term fixed-rate residential mortgage. In the United States, an individual can lock an interest rate for 30 years while retaining the option to refinance if rates fall, a spectacularly asymmetric instrument. Effectively free protection against the exact force that destroyed the syndicators. Commercial and bridge financing rarely offers that. Rerun the Sunbelt collapse with 30-year fixed debt on every property and most of those deals simply survive. Bruised. So the amateur's genuine advantage isn't hustle, or local knowledge, or sweat equity. It's boring debt, held patiently, with reserves. That's the whole edge. What does honest performance actually look like? 4 versions. The best case is a property bought below market with a structural advantage, a favorable purchase. A fixed low rate, a strong location. Over 20 years, modest cash flow compounds, amortization accelerates dramatically in the back half of the loan. Appreciation runs at or above inflation, and depreciation is deferred indefinitely through exchanges. This is real, it happens, and it's how a substantial number of ordinary people have built genuine wealth. It requires roughly 2 decades and no forced sales. The realistic success is less cinematic. Cash flow hovers around zero for years, and the honest annual return, once reserves are funded properly, might be modest, with the majority of it arriving as amortization and appreciation that can't be spent. The property is a forced savings vehicle with leverage and paperwork. It works. It just doesn't feel like it's working for a long time. The realistic disappointment: the property roughly breaks even, the owner performs unpaid labor as manager. And the return approximates what an index fund would have delivered without the 2 a.m. phone calls, while carrying concentration risk in a single building, a single tenant, and a single local economy. The failure is what we traced: an undercapitalized owner, a cost shock through escrow, deferred maintenance, a compounding repair, vacancy, a sale into a weaker market, and transaction costs finishing the job. The variable separating the last 2 from the first 2 is almost never the property. It's whether the owner had reserves, fixed-rate debt, and enough time that they were never forced to sell on someone else's schedule. Which brings us back to the napkin. 2,000 in, 1,400 out, 600 left. The numbers were right. What was missing is that the 600 was never compensation for owning a building. It was compensation for absorbing 3 separate risks that no one had priced: a stranger's willingness to pay, a physical object's certainty of decay, and a leveraged position's exposure to the price of money. That's what the rent is buying. Not shelter, shelter is what the tenant buys. The landlord is being paid to hold risk that arrives irregularly, invisibly, and all at once, and to remain solvent long enough for amortization and time to convert that patience into equity. Which means the question was never whether the property makes money. It's whether the owner can survive the years when it doesn't.